If you don't have a financial plan, you don't
Oh
control your
my
money.
God.
Your money controls you. Today, I'm breaking down the exact steps to build a clear financial plan that actually works. Let's start with retirement funds. Retirement savings usually are the first place you want to look for business funding, but in some situations, they can be an option. Certain non IRA retirement plans allow you to borrow money for business related needs. This could include taking a loan from a pension plan or another IRS approved retirement account. When you borrow this way, you typically pay interest on the loan, but that interest goes back into your own account. While that may sound appealing, many financial experts warn that borrowing from retirement savings can still cost you in the long run. The money you take out no longer has the chance to grow, and the potential earnings you miss may be far greater than the interest you repay. Another option is using your retirement funds as collateral for a loan instead of borrowing directly from them. However, this comes with serious risk. Just like any secured loan, if you fail to make payments, the lender could claim those retirement funds. In short, retirement savings can provide access to capital, but they should be used carefully and only after weighing the long term impact on your financial future. Next up, buying on time. Buying on time isn't a way to get cash upfront, but it is a smart way to get the supplies your business needs without paying immediately. Many businesses, both new and well established, purchase materials from their suppliers using trade credit. This approach is especially common in industries like construction, where companies regularly buy supplies on credit for each project they take on. While long term trusted customers usually receive the most flexible payment terms, new business owners may be surprised to find that supplier credit is often more affordable than using a personal or business credit card. This type of arrangement is commonly known as buying on time. It allows you to receive goods today and pay for them later, often within 30, 60, or even 90 days. And if the supplier does charge interest, it is typically much lower than what you would pay with a credit card. For startups trying to manage cash flow, buying on time can be a practical and cost effective way to keep the business moving without taking on expensive debt. Moving on to number three, personal savings. When putting together a financial plan for a new business, the first place you should look for funding is your own savings. Before turning to banks, loans, or investors, take a close look at what you already have available. Personal savings are the money you've intentionally set aside over time. This can include funds in a savings account, investments, money market accounts, or other personal assets meant for future use. Because this money already belongs to you, it gives you freedom and flexibility that other funding sources cannot. If someone else depends on these savings, such as a spouse or family member, it's important to have an honest conversation first. Decide together how much can be used for the business, whether the money will be paid back, if interest will apply, and when repayment should begin. Clear agreements upfront help prevent stress and conflict later. Using personal savings allows you to stay in control of your business without pressure from lenders or investors. You won't owe anyone explanations, reports, or deadlines beyond what you set for yourself. For many entrepreneurs, this makes personal savings the strongest and safest way to get started. If your savings are not yet where they need to be, it may be wise to wait and continue building them before launching. Starting your business without exhausting your emergency fund gives you peace of mind and a more stable foundation. Personal savings can provide independence, confidence, and a solid first step toward turning your business idea into reality. Last but not least, credit cards. Credit cards are one of the most common tools businesses use to pay for supplies, services, and everyday expenses. When you use a credit card, you are essentially borrowing money for a short period of time. If the balance is paid in full each month, you avoid interest and can use the card at no extra cost. However, using a personal credit card for business purchases can create real problems. One of the biggest challenges is keeping business spending separate from personal expenses. This separation is extremely important, especially when tax season arrives, and mixing the two can lead to confusion and costly mistakes. On the positive side, credit cards often provide stronger protection than paying with cash. Many major credit card companies offer consumers safeguards if a product turns out to be faulty, damaged, or unusable. In some cases, the card issuer may reverse the charge entirely and handle the dispute directly with the seller or manufacturer on your behalf. And that's all. Thank you for watching. I hope this was helpful.